The most important element is maintaining and owning and operating these properties. Tenants are our customers. You need to be responsive. You need to say yes as often as you can. When COVID hit, we all worked together and we got through it. We didn't lose any tenants, and I'm proud to say they're all still in business. Our motto has been servicing the tenant who is our customer. If you are not optimistic, you don't have hope, you're done. If you don't commit every day thinking that glass is half full, you're in the wrong place. You're not going to go very far. To me, it is 100% attitude. It's never as bad as you think it's going to be, and it's never as good as you think it's going to be. That's my wisdom, having done it for a long time. So you know what? Hang in there, and positive attitude will win the day.
Hi, everyone, and welcome to Design Development, your hub to learn direct from top performers in real estate development, design, and construction. I'm your host, Renz Hayes, founding partner of H&O Lifelong Learner, and I am personally obsessed with high-powered organizations and the leaders that guide them. If this is your first time listening, thanks so much for joining us. And if you're a returning listener, can't thank you enough. Let's go. Today's episode of Design Development, we're going to get into the state of the real estate market with John Parsons. He's the CEO and founder of Parsons Commercial Group. They're a vertically integrated real estate firm in the greater Boston area with a satellite office in Raleigh. John's a great personality, a people-first leader. He really pays it forward, but he's an amazing real estate talent. He has experience and exposure to past recessions in '89, the dot-com bubble, the 2008 recession, and then we're going to hear his insights into the asset classes that are struggling today and where you can think about and how do you strategize for opportunities to come out of this recession, because in any recession there is opportunity. We get to learn from John's story along the way. He worked for 3 years as a broker before going on his own, and a mentor of his said, if you really want to build wealth, you got to become an owner. And over the last 30 years, John's acquired 82 properties with over 5.2 million square feet. So he's somebody that has done it before and has a lot of great insights to share. So I hope you get a lot out of today's conversation. If there's anyone you know that would learn from it, which is literally everybody, you should share this conversation with them so they can learn a little bit more about real estate. Without further ado, let's get to my conversation with John Parsons. Please join me in welcoming John Parsons. John, thanks so much for joining us today.
My pleasure, Ren. Thanks for having me.
I've had a pleasure of getting to know you over the last few years through real estate and construction. We worked together a little bit, and then we both served on the board of Habitat for Humanity in Greater Worcester. And you actually introduced me to that board, so thank you. They're an affiliate we really enjoy helping, supporting, and growing. We're doing good things in Greater Worcester. If you could, let's share a little bit about yourself for the audience and let us know what Parsons Group is all about.
Certainly. So let me take a step back. I went to Northeastern University, graduated in the late 80s, and worked in the commercial real estate industry as a broker. 3 years into my brokerage career, decided I wanted to step out and start my own firm. And that was back in 1993. Mm-hmm. And we started Parsons Commercial Group, and we have been in business for over 30 years, and we currently operate out of Framingham, Massachusetts. We've got an office in Boston at 185 Devonshire Street, and we most recently opened an office in Pinehurst, where we manage a portfolio that we own in the North Carolina marketplace. So I describe Parsons Commercial Group as truly a full-service commercial real estate firm. We've got about 40 employees. We have approximately 14 brokers that are actively working on our properties, our portfolio, bringing opportunities for us to invest in. In addition to that, we are also representing third parties for leasing and sale of commercial properties, predominantly in the suburban Boston marketplace. We also have in-house, we're highly vertically integrated when it comes to property management. We've got a full-service property management firm. We manage over 5.5 million square feet that we own. We also do some third-party management as well. And in addition to that, we have an in-house construction division, which has proved very valuable over the years because a lot of our fit-ups and work that we need to do is smaller in nature, $500,000 or less, and very difficult to outsource that. So we've been able to self-perform that, control the cost, and that's been key to our success. So that's more of a high level of where we're at, but I'm happy to entertain any questions you may have or expand a little bit on that.
Great elevator pitch. It sets the stage for today's conversation. Big part of design development is sharing the guests, so your journey through your career, because we're helping people in the industry learn from your experience and see parallels in their story to yours, so that hopefully we can help them see their next step. You mentioned you were a broker for 3 years before deciding you wanted to take the entrepreneurial leap and start your own firm. What asset class were you focused on as a broker at that time?
Great question, Renz. I was predominantly focused on the industrial market in, I would say Metro West, that being, the boroughs, Marlborough, Southborough, Framingham, Natick, Westborough, and really cut my teeth in that market. And got some great advice early on from a mentor that said to me, you can make a terrific living as a broker, but if you want to become wealthy, you better own it. So that was really the push that I needed to start buying properties. And my first property I purchased was in 1994. It was a building in Hudson on Brent Drive, a small 25,000 square foot warehouse building. It was being foreclosed on by Baybank, which is a name from the past. Probably means nothing to you because you're so young, but that was a very large financial institution in our marketplace. And I bought it at a foreclosure auction. And from there, I was off to the races. And we began to acquire, 2 or 3 properties every year and kept building the portfolio.
Very nice. Now, did you have an early success with that first foreclosure? Did it need work? Like, tell us about that particular deal. And
it certainly needed work. It was not a pretty building, trust me. But we saw value. I mean, we refer to ourselves as, we're value-added buyers. I mean, we're not the type of group that's going to buy a CVS that has a 10-year lease, because to me, that's called a fully baked deal. You can't add any value. All you can do is own and operate it, and at the end of the lease, figure out what to do with that asset. But our true strength is utilizing our platform, because we have in-house capabilities as a brokerage company, in-house capabilities as a management company, in-house capabilities as a construction company. You take that platform and you apply it to a vacant asset. So what we're doing 2 things. We're buying the building right because of the brokerage company. Secondly, we're filling the building with tenants, which is really important, and keeping it full. And then any tenant fit up, we're able to perform and self-perform at a cost well below what the market would charge if we went out to the market and found a GC to handle our construction. And probably the most important element is maintaining and owning and operating these properties. I mean, it sounds like a very corny cliche, but the tenants are our customers. So you need to be responsive. You need to say yes as often as you can. There are certain times you have to say no, but classic cases when COVID hit, we all worked together and we got through it. We luckily, we didn't lose any tenants. We had some restaurants, we had some folks that had fitness centers, but we all got through it, and I'm proud to say they're all still in business. So, our motto has been, servicing the tenant who is our customer. And I think, our platform is pretty unique. There's not a lot of, you have a lot of development firms, you've got a lot of pure brokerage firms, you got some pure management firms. Very rare to have a suburban company like ours. There are a few, but not many in this marketplace. So we're very proud of that.
Very nice. And so you mentioned a fully baked deal. And what I hear when you say that is buying a building that already has a 10-year lease with someone like CVS. That means somebody's already created the upside and the value in the deal. And now you're really buying an asset to own it for its operational cash flow and then long-term, very long-term appreciation, right? That's
correct. Correct.
So,
and, a lot of it, I'm sorry to interrupt you, but a lot of the CVS type single tenant deals, all net deals are, usually 1031 tax for exchange. I may have had a property that I sold out of, and I don't.
Reservation of capital.
Yes. And I'm going to be down in Florida. And I don't want to, be busy managing the property. So I'm going to buy a CVS. The rent check will come every month. I don't have to worry about it, which I'm not saying that's a bad concept. It's just not our concept.
Sure. Yeah, there's a different strategy for everybody and for certain pockets of your investments.
Correct.
Very nice. And do you see risk, this is kind of a sidebar, but risk in a single tenant, say, deal for, say, a CVS? Like at the end of that 10-year lease, if they don't renew, you're kind of stuck with an asset that you now have to invest in again to try to get the same value
Great
back.
point. So to answer your question, yes. And CVS and Walgreens are notorious for going to the next best intersection. So you may get CVS for 10 years or 20 years, but at some point you're going to basically have a building that you paid, a big number for, that you need a rent of $38, $40 a foot when the market is at 20 if you had to bring it out to a non-CVS, a more traditional retail tenant. So that's a tricky balancing act. It really is.
And so going back to your investment philosophy, so you're still, and maybe to this day on a development side, you're looking for underperforming, say, industrial commercial assets that you can then identify a tenant to plug into that building because you know how to improve the building and then find the tenants that would see that as a valuable asset.
So real time, I just closed yesterday on a property in Ashland, Massachusetts. It was a 40,000 square foot warehouse medical manufacturing company. They had been there 32 years. They just built a very large facility in Costa Rica. Cost to do business here in the United States was very expensive. They couldn't get labor. So they approached us to sell the property about a year and a half ago. And we brought it to the marketplace. And most of the potential buyers didn't want to wait a year. We said, look, we'll take our brokerage hat off. We'll buy the property and we'll wait a year. So, that year gave us some lead time. We went out to the marketplace and we bought the building vacant at a number. And then we found a tenant and very large union roofing contractor who just signed a 10-year lease at a number that is market, but it was basically a home run for us. So we created the value, got all our money back and then some just by being able to, find a building that's vacant, re-tenant it, and do it in a cost-effective manner. And now we've got a predictive cash flow for the next 10 years.
Yeah, that's fantastic. And architects and engineers and people outside of commercial real estate development don't always understand how commercial real estate properties are evaluated. And I too am honestly learning this. So I'll share what I learned and get your feedback. But you really helped a company that's looking to move their operation elsewhere, which means their opportunity cost of holding on to this building, it's something they didn't want to deal with anymore. Their best value was finding a way to get out, not getting the most top dollar on that asset. You were able to solve their problem short term, take this long-term risk, but by plugging in an operator at market rate, you change the value of the net operating income at that point, which allowed you to reassess the property value of this asset that you now own.
Right on. I mean, Ren, real estate is like every other investment. When you look at an investment, most people, you have to evaluate the risk. So where am I on the risk curve? A lot of folks would not look to buy that building in Ashland, have a vacant building, because they're looking at the risk curve saying, well, geez, what if it takes me a year? What if it takes me 2 years? What if it's going to cost me $2 million to re-tenant it? Because of our skill set and our experiences and our tenant base, we were able to fill it rather quickly. And it truly was, kind of a win-win situation for the seller and for us. And just as a matter of course, the seller has other facilities on the East Coast that we're now talking to them about potentially buying. So there is, a situation where certainty of close is the most important thing. Whether you're buying real estate or performing, buying a corporation, sellers want to take the risk out of the fact that you've spent time on due diligence and then you don't show up to the closing table. So reputation is important, and we've got a strong reputation. If we put a property in agreement, we close on it. We are not classic retraders. We get things done, and that speaks volumes. So that's very, very important in this marketplace.
Sure does. It seems, I know your brand, and I can't drive anywhere off of 495 without seeing a Parsons sign out there, Parsons Commercial Group, SVN, like you're all over the 495 belt. It seems the tenant access or the tenant knowledge or like being aware of like who your actual end user is on these properties is a huge lever for you. How did you develop these relationships? How did you develop an understanding of that market?
Well, I think one of the key components of that would be our brokerage group. I give a lot of credit to the brokers that have, I've got some folks that have been with me 15, 20 years, and they have been instrumental in our success. And I preach all day long, if you have a requirement and you're having trouble filling it, let's sit down with this company and see if we can, buy a building together. I can give you examples. I own a building in Northborough where it's 100,000 square feet, and two of the owners are tenants in the building as well. That's been a very successful formula. Same thing in Marlborough, 214 Cedar Hill Road, industrial building. I had a company, Patriot Restoration. They were looking for a home. I said, let's buy something together. So, they would prefer to own a piece as opposed to just renting. And that's been a very successful formula. But also, in the meantime, we do have companies that are happy to have us own the entire building, and they'll come in as a good tenant. And I think, it's a little bit of a checkerboard or a chess piece that you're moving around and trying to fit it all in. And that goes to the portfolio as well. I mean, we've got, you know, 300 tenants. So we're always in constant contact with our tenants to understand what their needs are. And okay, this may not work for you here because the building's too big, but I've got a building over here, or they're outgrowing their space. I mean, we've got, probably 20 tenants that are multiple buildings of ours.
Yeah.
Advocates being one of them. SRS Heritage, a big roofing supplier company. They're in North Attleboro. They're in Sudbury. Three Step Sports. They're in Mansfield. They're in Sudbury. So, we try to have terrific relationships so that our tenants want to expand and work with us at other locations.
And that momentum builds over time.
Certainly does. I mean, you just have to be responsive and do the right thing. And you need to look at the long game. There are often times where a tenant will come back and say, geez, you guys were, a month late, or something happened, you couldn't deliver the space, can I have a month free rent? You know what? Generally, we say yes, because if you're going to a 5 or 10 year relationship, what difference does a month's rent make? You got to have a tenant that's happy, and a happy tenant is going to be terrific moving forward for 5 or 10 years and beyond.
That's a great lesson. What's the lifetime value of that relationship? Like you don't want to ruin this 20-year run in partnership over 1 month of volatility. It's really
100%.
So going back to the early days, 3 years in brokerage, you decide to launch your firm. You have a mentor tell you the importance of owning real estate assets. You bought, I think you said 94. How did the growth of this company start? So I imagine you're starting off as a brokerage, and it seems like you pretty much bought a building right out of the gate. And did you just operate both of those business lines concurrently as you scaled? Like, how did this growth happen?
So I did. I think this is a good segue into talking about, the recessions that we've gone through. So let's back up for a minute. 1989. I mean, that was a very, very difficult time for a lot of people in real estate. Here I was, 22, 23 years old, fresh out of school, and I saw folks that were losing their, life fortune. They had built portfolios over 25, 30 years, and a lot of it was not due to anything they did. In other words, FDIC came in, and they actually set up an office in Franklin, Mass, and they marked everything to market. So if you had an office building that you thought was worth $100, but an appraisal says it's worth $70, even if you were paying your debt service, FDIC came in and said, okay, you need to write us a check for the difference. And most developers didn't have that liquidity. So that really caused the market to implode. So you had a lot of properties going back to the banks.
That's a massive hurdle.
It was very, very difficult. So the upshot of that is, from a brokerage side, we did a lot of business with banks. We worked for the FDIC. We worked with Recall Management. Recall Management was a spinoff of Bank Boston. We did a lot of work with Metro West Savings Bank, which eventually became part of TD. We did a lot of work for Middlesex Bank. Tremendous amount of community banks that had OREO properties, troubled assets. That allowed our brokerage firm to really flourish from, call it, 94 all the way till 96 till we really started to come out of this. And then we had a nice run. We had a little blip in the 2002, 2003 .com bust. Yep. But it was really isolated to tech companies. So we didn't feel that. That was a little turbulence. I wouldn't call that a true recession from a real estate standpoint. And then obviously in 2008, 2009, it was catastrophic. I mean, every segment of our market, every tenant was having issues. Every tenant was, trying to give back space. It was just a really scary time. I mean, our bank system almost failed. So, that you learn lessons every time you go through. So, again, now we're fast forward. We're in a situation where, based on different asset classes, we are going to, I think we're in the second or third inning of this catastrophic office market, which is going to really be problematic, not just for the next year, for the next several years, until we can figure out how to repurpose these buildings. There's been a sea change in how people occupy office space. And if you want to be competitive and keep your employees, with your firm, you need to be flexible. You need to say, I'll go to a 3-day work week. So, I think that when you look at the office market right now, especially the urban market, you've got vacancies that are in the true vacancies in the 20 to 25% range. But even more troubling, you've got almost 50% dark space. So what does dark space mean? Dark space means that people are paying on it but not using it. So what does dark space become eventually? Vacancy.
Yes.
And just if I can speak to the Boston office market right now, what's happening now, you've got a flight to quality. So you've got new properties being developed in the Seaport, whether it's WS Development, a lot of other developers that have had pieces in the Seaport that have finally got permits and have come out of the ground. they're now delivering the space, and everyone's competing for tenants very aggressively. But what's happening is they're pulling tenants from the financial district. I mean, if someone's going to move from PO Square, they're going to want to move to Seaport, and they're going to be in a new building overlooking the water with tremendous amount of retail, and they're going to pay top dollar, but they're willing to pay top dollar because they need to attract employees back to the office, and that's been a real challenge. So I think until that phenomena changes, you're going to see the office market struggling. And the problem with office space, Renz, is that whether it's suburban or urban, your capital expenditures on these buildings are tremendous. So if I'm releasing a building in Framingham right now, I'm going to spend $60 a foot on tenant fit up. If I'm releasing a building in Boston right now, I'm going to spend $110 in fit up. So what happens is your basis keeps getting higher and higher in the building, and at some point the math doesn't work. And we're at that point. There's an inflection point where if I'm only getting $50 or $60 for office space in the financial district, I can't spend $110 on tenant fit up and another $20 a foot on brokerage fees and make this work. So you've got, and oh, by the way, you're in an interest rate climate that's, double what it was a year ago, and then some. So you're going to see a lot of office buildings, especially urban buildings, going back to the lenders, which is too bad. And again, it'll be a cycle. It'll take time. Buildings will be repurposed, and we'll move on from there. But it's going to be very crucial that these municipalities and cities work with the towns and we'll work with the ownership and let them have the permits to make these mixed-use properties. You can see a lot of office buildings where it makes sense becoming apartments, multifamily, or a combination of retail on the first floor, multifamily on the top floor. So that's going to be, it's already started. I mean, Washington, D.C. has 22 million square feet of vacant office space. New York City has 71 million square feet of vacant office space, and the demand is anemic. So something's going to give.
Something's going to give is right. And Class A office space, as you point out, new Class A office space in the hot growing region in a city like Seaport is still sought after space. It is. The Class B, the Class C office space that was properly located before, those are the properties that are going to really struggle.
Totally agree.
I'll say from our side, and I'd be interested to hear your perspectives on converting office to, say, multifamily. There's a big hurdle there, too, that I still think is going to include a lender, because the cost to update an office building to a residential building is tremendous. The vertical transportation's generally different. Your plumbing, your mechanical, your electrical, all of that's completely different. These are open floor plans that have different floor depths, and now we got to introduce
more window lines. It gets very, very funky to use a word, and at a certain point, it doesn't make sense. So let's just say that maybe 10 to 20% of those office buildings could be converted to residential where it makes sense, but there's going to be some where it's just going to be better off, demolishing them and starting over.
I think it's less than 10%.
Yeah, it could be.
It's well less than
Again,
that.
that's you and your structural wisdom could be the one that calls that. So I agree with you on that.
I would say on, let's say, some of the smaller buildings, when we're talking the challenges here are really on, let's say, the vertical downtown financial high rise. I think those buildings are extremely challenging. That's not to say every office building or commercial building can't be. There's the other quirky ones and the old brick brownstone type buildings, the brick masonry with wood infill, those could be converted, and maybe some of these other buildings on the 495 belt could actually be converted in a more cost effective way. The vertical building,
I don't disagree. We're working on a small project in Worcester, 48 units, and older mill building, 2 stories, so nothing crazy, and the numbers are at $230 to retrofit it, and as you know, ground up is probably $275 to $310, so it still makes sense, but there's not a ton of room. Let's put it that way, not a ton of room.
I think the mill building conversion is an excellent model, particularly
I do too.
Today. And sometimes you can get historic tax credits there. There's other advantages. So
that is the play.
Yeah, that's the play. I like that.
That's the play.
Going to the commercial space, the industrial, you mentioned a 40,000 square foot building. When I see a lot of industrial buildings coming to market, they're 100,000 square foot plus, because the old industrial was the operator, the manufacturer, the roofing company, the steel company. Now these buildings that are coming to market, the brand new ones, are 35 feet clear span. They're 100,000 square feet to 600,000 square feet, and they're primarily geared towards distribution. When you look at that asset class, What kind of sweet spot are you looking at for a building, or what's the hard building to move?
So great point. We're going through permits right now in Bellingham for a new 65,000 square foot building. We're going to come out of the ground with that probably in the spring. Great location, 5 minutes to 495 near the Amazon building. So we are confident that we're going to get one user. If I were building this building 25 years ago, I would say, hey guys, let's make sure we design this so it breaks up every 20,000 square feet. The demand is still so strong in the industrial sector that we'll get a full building user. We're very confident of that. Same is true. We're down in Bloomfield, Connecticut. We are in the process of just beginning permitting on 85,000 square feet of warehouse space adjacent to a Home Depot warehouse. And again, we are going to go 32-foot clear. Your minimum clear height has to be 32 because
Yep.
everyone is talking about how much space, how much product can I get in the cubic area that I have. I that is so key. How narrow can I get the racking system? How efficient can it be? And the inventory control systems now are tremendous. The ESFR sprinkler systems are required, and you've got to be cutting edge. A lot of warehouse users love the cross-dock. Depending on the site, if you can do it, that's a great way to do it. But we're building right now is 32-foot clear minimum. Very little office. You'll put 10% office. So if that. In a building that's 65,000 square feet, we'll probably put 3,000 square feet of office because you're just going to need some warehouse personnel, one or two offices, and you're done. So that is the model, and we're able to build that now for about 100 metal panelized buildings, about 120 to 130 a foot. If you start moving to tilt-up concrete, you're going to be in that 160 to 170 range for construction numbers.
And you're talking hard costs, or you're talking all in with land?
I'm talking hard cost without the land.
Yeah,
Soft cost, hard cost without the land.
That's an increase, especially in the last few years, right?
Oh, absolutely. We used to build metal buildings, even 3 years ago for $80 a foot. And yet you can do it in certain parts of the country. Just in New England, it's really difficult, difficult. But again, you're getting rents though. You're getting rents that were, in the $6 to $7 range. In the $14 to $16 range, which really allows you to complete that circle, being able to acquire land, build a building, and then basically get a rent that allows you to make some sense out of the deal.
The economics still work, which is
absolutely.
Hey everyone, quick break from the episode. If you're enjoying today's episode, please send this to a friend, like, share, comment, subscribe. It's the only way we're going to help more people. Let's get back to the show. With the pressure of the capital markets, you already mentioned, and I think everyone's aware of the rising interest rates and the impact that can have on the cost of capital. What markets are feeling that the most, right? We're talking industrial, still fortunately can pencil. Like, where is that putting the most pressure on?
Yeah, I think this would be a good time for me to maybe go asset class by asset class, talk a little bit about each, and then I'll chime in on how I think the interest rates are affecting each asset class. So let's start with office. I mean, that really is the problem. Okay, so office space right now there's been a sea change, a structural change on how companies are using space. Before we'd have 25 private offices and 5,000 square feet. Well, that's no longer the model. The model is set up some hoteling offices, set up some cubicles, because we're going to have folks coming in. We're going to have one group of folks that are going to come in on Mondays, Fridays, and the other folks that are going to come in Tuesday, Wednesday, Thursday. So it's the new norm, which is going to be difficult because the overall amount of net absorption is the term we use for office space. The net absorption is going to be negative for some time. So that sector is going to be in some substantial pain. In addition to that, I mentioned earlier when we were speaking that you need to come up with tenant fit up. Well, if I'm building out space and I need to build out 100,000 square feet of office space, my all-in cost, let's say $75 a foot, where am I going to get that money? It used to be very simple. I go to the bank and I say, hey guys, I've got a brand new lease, good credit tenant, loan me the money. That's not happening now. Banks are not looking to loan on office space, period.
That's a good insight.
Yeah, maybe medical office space, and if you've got a solid, life science tenant, they will loan, but they are not speculating on office space. They are not putting money out that they don't have to right now. That's the whole approach with the banks at this point. They're conserving capital, and I'll chat a little bit more about that in a minute. So moving from that asset class, of office space to industrial. So industrial space, that is still strong, will continue to be strong. Do I think the rent growth will stop? Yes. I mean, we've had rent growth that has been, incredible in the last 3 to 5 years. And we'll talk about rent.
Historic.
Yeah, I mean, yeah, historic. So rents that when I owned 2545 South Street in Hopkinton, your hometown, I used to get $7 a foot. That same building today is 14 a foot. And this is only 5 years ago. So rents have doubled, okay? And the reason for that is there's been virtually no speculative industrial development in the last 25 years. So after the crash of, call it 89, 90, everyone got very, very conservative. You saw very little spec flex space, little here and there, very little warehouse space. And the upshot of that is we ran out of space. So
that's a good insight. And the demand went through the roof with distribution.
Went through the roof, right. So yeah, with our economy changing and moving to an online economy, warehouse space is really crucial and important. And you've got other uses. The cannabis industry ate up a lot of space in this Massachusetts market. And then, the food chain just starts with, okay, I want the best location. Well, that's taken by Amazon. Okay, then move to the B location. Well, that's taken by some cannabis. Okay, now what else is available? So stuff that we had in tertiary markets, Holliston, getting $12 a foot triple net in Holliston, Massachusetts. I mean, that was $4 space 10 years ago. So that growth I expect to continue. Again, I think if I'm underwriting a deal and modeling it out right now, I'm not assuming my rents are going to continue to go up. I'm saying, okay, let's plateau where we are now and be happy. Because I do think you're going to see some industrial subleases coming on the market. You got big companies like Amazon. But the reality is when Amazon cuts space, it's not 20,000, 30,000. It's here's 300 back. So those having buildings that accommodate users below 50,000 square feet is always going to win the day.
And I'd love your feedback on this perspective. When I look at that rent growth, like let's call it Holliston, 45 an hour outside of Boston, right? The amount of people that they can service and how the online next day delivery industries have kind of pushed. Location has such a premium for those companies because the operational cost of getting product to consumers is considerably different if you're a half hour away from the population, which is where you can drive those rent growths.
Well, I mean, talk about towns like Westboro, talk about towns like Hopkinton. What's the value? The value is you're off 195, you're one exit from the Mass Pike, you've got Route 9 close by, and oh, by the way, you want to get to 95, that's pretty darn close as well. So those locations, you can legitimately service, your hubs in New England from a location like Hopkinton. That's why it's been such a valuable spot. And, so as far as the industrial asset class, that's kind of where that is now. And I think it's going to continue to be a valuable asset class to own. Low risk, low CapEx. Once they put a tenant in there, let's just say in 5 years, the guy that's storing widgets moves out. We get a new guy storing widgets. We're not coming in and saying, okay, now we're going to spend $500,000 to rebuild the office space. That's not happening in industrial.
You don't need to ask the bank for the $75 a foot there.
You got it. So that's key. My whole famous saying, you're rebuying an office building every 5 years, meaning, you just keep putting more and more into it. And when you have rates that are flat, you're never going to get that back. So that's kind of my position on office space, my position on industrial. Multifamily, really interesting asset class. I think it is a terrific asset class to own. Do I think there's going to be pain in multifamily? I think where the pain is going to come from is buyers that purchased properties in the last 3 years that have notes coming due where the rent growth has not caught up with the interest rate doubling. So let me just give you an example. If I bought a project for $20 million and I had an interest rate of 3% interest only, well, okay, that's really easy to carry. Now, all of a sudden, my interest-only period's over, and oh, by the way, I've got to take it out and refinance it at today's rates at 7%, you're going to have a disconnect. So that's where you're going to have some pain. People that overpaid, the basis was too high, the rents didn't catch up, and that's where you're going to have some issues.
If you could help me understand that example of, I think you said $200 million, is that buying an existing leased up asset that's already built?
Yeah. So let's say you bought an apartment complex from someone and you said, look, I'm going to buy it. The term cap rate in our business is, so people were buying at sub 5 cap rate. So in simple terms, kind of the rate of return requirement was below 5% going in because they felt like they could increase rents and add value. And in certain instances, you do that. I mean, you clearly have the opportunity to make some modifications, physical changes to the property that'll result in rent increases. However, are your rent increases going to be able to keep up with a new interest rate environment that has gone from 3% interest only to 7% with principal and amortization? The answer is no. So that's when you're going to have some difficulties, and you have some workouts. You'll have some properties that'll go back. But I truly believe in the multifamily asset class. It is, there's someone for that seat. In other words, I've owned office buildings out in Littleton that I paid $20 a foot for. I couldn't find someone for that seat. It sat vacant for a year or two. I have an apartment. I put the number out there. Someone will fill that apartment. It may not be the number I want, but you will find someone. There's always. And I think if you look at our demographics now, you've got a whole generation of young folks that, first thing I did was when I got out of college was, get a job, get married, save for a house. Now the desire and the ability to afford houses almost seems out of reach. So you're going to have a whole generation of folks that are going to be renters. You're going to have, I think the rental market is going to continue to be strong, and it's a great place to put money because, multifamily, you can hire a manager, can be hands off, or if you want to get highly involved, you can self-manage and be as involved or not as involved as you want. And again, I think it's a highly sellable asset. If you have an apartment building, you will sell it. So when we list an apartment building here now, we're going to have 10 offers. I don't care what the interest rates are. We'll have 10 offers. They may not be the offers I want. We'll have 10 buyers. I could put an office building out there, and I may not have a buyer at all right now in this market. So still very bullish on the multifamily market.
That's a huge difference compared to the office, because the office, there's going to be bigger losses and no one that's going to want to buy the asset anywhere close to the note that they owe on the property.
Correct. So someone's going to take a haircut.
Multifamily, there might be a small haircut because interest rates move, but it's still a product that will have tenants. There's a huge tenant demand, and you're going to find a buyer no matter what. So the haircut's a lot smaller. So
I think what you're going to see some of too, Renz, is you're going to see office product that's vacant going back to lenders, and then warehouse distribution developers saying, okay, I'm going to scrape this 2-story brick office building. I'm going to use the infrastructure. I've got, my sewer lines in, my parking lot's built. I've got lights and I've got everything in place. Now I just want to go in. I'm going to demo it, do what I have to do to put in a warehouse building. And instead of having a parking field with 1,000 cars, I only need 100 cars, and I can add the square footage. And I just get to a number where that, FAR, floor area ratio, that if I'm paying under $40 or $50 a foot, I can make that work. Because again, we take the cost of the land, cost of the building. We talked about a warehouse building being 120, 125. So now my all-in's at 175. If I'm getting a rent at, call it 15 to 16, that works all day long.
Math works. That's a really great use. So that's like a 2-story office building that might be on 95, 495 built outside the city.
Right. And no one wants to, basically in the old days, you'd buy that big building that NEC vacated or Digital vacated, and you start cutting it up. And you say, okay, I'm going to make this multi-tenant. Yeah. And that used to work. But why it doesn't work now is because the cost to subdivide and the cost to build out is exponentially higher, and you're not going to get rents to support that. As you know, we bought the former EMC headquarters at 35 Parkwood in Hopkinton. Timing was everything. We bought it for $3.5 million, which was about $23 a foot. And we essentially subdivided it to about 12 tenants and spent roughly $8 million. So again, follow the math, $3.5 million at $8 million. Okay, so basically you're 11.5, all filled, all ready to go. It took us about 18 months. And then we had a value of, once it was fully leased, at about $22.5 million. So that's how you're creating value. So you're taking the whole and breaking it up incrementally, filling it, getting rents, and calling it a day. Now, that was a great example. That was 3 years ago. So now today we're in a different environment. The banks are not lending on speculative developments like that. So they say, okay, you come and see us when you have the tenants lined up, or you're 75% leased, and maybe we'll give you some money. So that's kind of, how we do it. I mean, in really simplistic form, real estate is as simple as if I buy it for $1 and I can spend 50 cents to tenant it, fill it up, and it's worth $2. That's the game.
You do it all day.
All day long. It's
Anytime
that
you
simple.
I love
And
that.
then, and then for me, I mean, each investor has a different mindset. For me, I would prefer to hold the asset long term. We've sold maybe 3, 4 buildings that we've owned in
Oh,
a career
wow.
in 25 years. We don't sell a lot because I'm all about the passive income. So if you look at a portfolio, you own it long enough, you're paying down principal, and you're arguably you hold on to it, you operate it well, your rents go up. So when you own it for quite a bit of time, you're just building that cash flow and creating wealth in that model.
Yeah. And like you said, you're paying down principal and then your net operating income goes up, which is increasing the value of all that property on top
100%.
of
Yep.
appreciation. That's
Absolutely. And we have buildings that we bought, industrial buildings at $25, $30 a foot that are now worth $175 a foot. And again, we had no crystal ball. We just bought it, operated it, and luckily the market cooperated, and we were able to get some terrific rental increases. And we just want to continue to do that, and that's why we're focused on industrial buildings. And we bought a large portfolio down in the Carolinas, in the suburban Charlotte market. And again, we bought based on current rents. Well, the current rents were $3 a foot, so we got a little aggressive on the buy, saying, okay, we're going to squeak out a 5 or 6% return the minute we buy it. But as these tenants renew, we know the market for that space is at 5.50 to 6. Luckily, we're getting 6 and better right now with good credit tenants. We've got Restoration Hardware, we've got Reynolds Tobacco, we've got Ferguson Electric, we've got some really strong credit tenants.
Yeah,
And
sure do.
we're Haywood Pools, another great tenant. They're $4 billion company. So we're very fortunate, and that model there is basically buying an asset with rents in place today with the understanding that as they roll, if we can get at that portfolio, we're going to bring it to market, and that's how you're going to create the value.
Let's go to life science. There's a
Yeah,
lot of people that are bullish on life science. There's been the phase one downtown R&D work, and then there's the outside of the city that's more phase two, phase three, your CGMP facilities for drug manufacturing. There's people in both camps. Like it's a bullish asset class. It's been what's stimulating growth in the greater Boston area, creates great jobs and opportunity. There's investment capital behind it. With the recent capital markets, you're not seeing any speculative lab go forward anymore. It's only if there's a tenant involved. So, and I know you're around this arena, so if you could share insights into life science and your kind of predictions for the future.
absolutely. I mean, look, I am still all about life science. I think it's a terrific asset class, but I think we have to look at it from a realistic perspective. It is not going to be the savior of the office market. And you've got a lot of saturation right now, a lot of product in queue. I mean, there was 20 million square feet of quote unquote life science queued up over the last 2 to 3 years that has not been fully executed on, and now we're at a point where I think we're reaching saturation. And the problem is the cost, and we talked about cost to construct office space, double that if you're doing life science. And that, depending on the particulars, it can run from a low of 120 to a high of 500 a foot. So you need to get the rent to the commensurate with that. So, and everyone's competing very, very hard for those tenants. Waltham has been a little bit of a mecca of life science. We have a little bit out here in Framingham, a little bit in Hopkinton, but obviously Cambridge is ground zero, and that became saturated. They just kept moving out.
Sure.
And then Waltham was the next stop down Route 2, and you've got a lot of office buildings that have been converted. You've got a few buildings coming out of the ground now, life science buildings. And the big question is there going to be tenants for those buildings? And right now, I think that it's going to take some time. I mean, I think the absorption could take, 5 to 7 years till we have more of a hunger for new life science space. There just seems to be an adequate supply right now with what we're seeing. And, in Weston, right before you get on the Mass Pike, the old Liberty Mutual campus, it's a great location for life science. I mean, that's quote unquote best in class. If you're competing against other locations, that's an A location. I mean, so I do think that, good locations are going to go. You're going to have some folks that are going to say, you know what, we're going to put, first of all, the financial providers. You've got banks that are not going to loan money on it. So, we had a life science deal teed up just in the Boston market that was under agreement for 2 years. The plug was just pulled due to the fact that, the financial modeling doesn't work any longer. So you're going to see more of that.
And so that again is a bank being hesitant to loan on a speculative building. So they want
Exactly.
to see a tenant involved for them to actually make the loan.
They do. And look, some of these institutional investors that are backing these local developers, they have to believe in it too. They have to, not just the banks. I mean, if they're writing a big check for equity, they have to say, hey, does this still make sense? Given the cost of construction, given the demand, are we going to be able to fill this life science space at a number that's going to have, make any kind of sense? And the
Yeah.
problem with life science space is very, very particular. It's very custom. Now, granted, you're getting long-term leases, you're getting 10-year leases. No one's doing life science for 5 years. You just can't. And generally speaking, you're getting some good credit, but it's I think a market that we all assume was going to be the savior, that unfortunately is going to be overbuilt at this point.
Going to be overbuilt. I appreciate that insight. And so, correlations, advice you have for navigating economic times. If we use your story, you went through the '89 recession. It seems like the FDIC like really created a damper on real estate. You fought through 2008. Like, do you see parallels to today's environment? How did you navigate those or reduce risk to create opportunity for your upside? Because you obviously navigated well.
Sure. Look, I mean, for most folks, when a recession hits, I mean, obviously it's painful, but it brings opportunities. So we talked about some of these office buildings going back to the bank. Maybe some apartments are going to be going back to the lenders. So there in itself is an opportunity. So that's when developers and investors become opportunistic buyers and go in and reposition an asset so that they'll be buying opportunities. So that's the silver lining. But the reality is, I hate to use this cliche again, tough times don't last, tough people do. I truly believe in that. Put your head down, get through the next 24 months, and it's going to be all right. A lot of that has to do with political climate, where we end up in the next cycle of elections, how the market perceives that, how interest rates. I mean, right now we've got sticky inflation. We've got it down to 6, but think about this: if it 8 or 9 rate increases, inflation should be down to 2 or 3. It's just not. It's at 6. And the difference, you asked me the nuances about the different. Okay, the thing that is really puzzling is the unemployment rate is still so low. Everyone is having a difficult time finding help. Our workforce, it's amazing. It's like, where did everyone go? And I don't have an answer for that, but that's a real time problem. And so that in itself is different. And again, the other difference which we've touched upon is I've never seen a structural change in office space in my, call it 35 years of real estate like we have now, where people are truly working. And that's a combination of, COVID, but also technology. I mean, here we are doing a podcast and you're in your location and I'm in my location. Well, if this was 10 years ago, we'd be in a studio.
For sure.
You can't fight technology. You have to embrace it. But that doesn't mean it's not painful when you're embracing it, because change can be painful, but on the other side, it will be good. But it's also interesting to note that we, do a lot of work down in the Southeast. Office market's very different in Florida. Very different. Your vacancy rate is about 8%. Go figure. Because those folks never stop going to work. And we had a situation in the Northeast and, out in the West Coast where you had folks that didn't go to work. And once you get into that mode where I can complete my job, in the comfort of my home and be able to take care of the kids and do it all, it's really tough to compete for those employees that you were going to require to come in 5 days a week. It gets very difficult.
I personally am interested to see how the new office standard kind of settles in over the next few years. Like, a lot of the demand to work from home and let's say the permission from a company to work from home has been a product of a bull market.
Correct.
Like it was very much an employees market over the last few years where work wasn't scarce. Everybody needed help. If the recession were to hold on, it's going to flip that script to where people are going to be looking for work. And when you're looking for work, and if companies aren't set up to be successful with a remote environment, they're going to require them back in the office. And how many of us actually want to work from home all the time? I love the flexibility of today's environment. I work from my house some days. I'm into Boston a handful of days a week. Like, I have flexibility to still execute and create outcomes without having to be in one seat every day, all day to make it happen. It gives me a lot more opportunity and flexibility. But the flexibility is what I love. I don't want to not go to the office. I still want the space.
No, I mean, which is, I think, a healthy attitude to have. I mean, I'm going to show my age now, but I truly believe that, when you are not when you don't have your team in the office, the mentoring, the collaboration of ideas, the social
100%.
aspects, I think it affects everyone. Affects the company, number one. It affects our ability to feel like we're a team and we're all working together. And at the end of the day, loyalty. I mean, I think if you are with someone 5 days a week, 40 some odd hours, there's a sense of loyalty that I have to my employees have to me. And when they're remote, it's a very difficult thing to build. And also paying it forward. I have a lot of friends that are in the wealth management business, and they're sitting around a fire pit chiming how they love working from home. And I called them out. I said, you know what? So how are you paying it forward? What are you doing for the guy that's 25? Are you teaching him the business? Are you showing him, what the next steps are? And they didn't have an answer. I said, I'll
Yeah.
answer that. You're not. You're
Yeah.
not. So to me, as much as I have no problem with someone saying, look, Monday, Friday's going to work from home, but those other 3 days, get in there Tuesday, Wednesday, Thursday, and teach the next generation how to do what we do is really important.
John, that's an excellent point, and I think you're 100% correct. And so a way that we try to counteract that at H&O is we make it a part of somebody's position agreement. It's not just design buildings.
Right.
It's be a part of mentoring and passing it on to the next generation, be a part of contributing to the culture, the execution framework, the training, all of those things. Like, that is a part of our responsibility as a team member at H&O. And if we can do that successfully remote, great. But if it's not going well, what are we doing to overcome that? Maybe we collectively decide we do need to be in the office. Maybe it's a different framework. We invite people into the solution. Just because we enjoy flexibility, sometimes the need or the demand for flexibility can be selfish.
Yes.
Right?
Yep.
That's a very me-focused thing. But if we're focused on improving the team, maybe there's a better environment for that. So,
Well, and again, I acquiesced. Starting Memorial Day, we are closed noontime on Fridays. Now, that was something we've never done, but I said, you know what? I think that's a healthy thing. It's a balance, and the employees are thrilled. To me, I'm all about being reasonable, but at the same time, I think the collaboration and the ability, at least in our business. So if I'm sitting in a sales meeting in my office Tuesday morning and we're going